Welcome to this explainer. Okay, let's just jump right in and explore the absolute dream, earning money while you sleep from multiple diverse income streams. Imagine a hypothetical professional who did everything right. They've got a lucrative full-time job, a thriving side hustle, a couple of cash-flowing rental properties, and an automated online business. They're making more money than ever before. But behind the scenes, a massive financial storm is brewing. We hear it all the time from top experts, right? Diversify your income, build resilience, don't rely on just one source. It's the modern gold standard for building wealth. But here's the thing, mastering diverse income sources isn't just about the thrill of earning. It is absolutely crucial that you know how to protect that money from becoming a compounding tax nightmare once it's actually yours.
Part 1. The Multi-Income Tax Trap, the Dream versus the Reality.
You picture multiple streams of cash effortlessly flowing into a single bank account, right? You wake up, check your dashboard, and boom, a digital product sold, a tenant paid rent, a dividend dropped. It feels totally effortless. But the reality is a much more complicated story. Every one of those transactions carries an invisible string attached to the tax authorities, just waiting to be reconciled at the end of the year. So, 5 income streams? Is it the ultimate financial dream? What if I told you that stacking up these diverse streams can actually trigger an unexpected, compounding tax nightmare if you aren't thoroughly prepared? Every single new stream introduces totally different rules, varying tax brackets, and distinct reporting requirements. If your system isn't ready for that data flood, that dream quickly morphs into a massive administrative headache that swallows up all the profit you worked so hard to generate. Financial experts warn us about this constantly. Many spend years building multiple sources of income only to discover they're completely unprepared for the tax consequences. This happens to highly ambitious people all the time. Without a rock-solid plan, adding more income literally just adds agonizing layers of paperwork, costly mistakes, and deep financial stress. You sacrifice your nights and weekends to earn that extra dollar, only to lose a huge chunk of it to unexpected penalties. Why? Simply because your tax strategy didn't scale with your ambition. Section 2, 5 streams, 5 challenges, and the compounding weight of taxation. We're going to look closely at 5 distinct income streams right now. For each one, we'll examine how it generates wealth, the catastrophic mistakes people make, the consequences, and the hidden tax planning opportunities you need to seize. Looking at this perfectly diversified portfolio, spanning employment, freelance work, investments, rentals, and an online business, it's the gold standard for wealth for sure. But here's the catch. Every single one of these ventures requires a totally different tax strategy. They do not behave the same way on your tax return. A dollar from your boss is viewed through a completely different legislative lens than a dollar from a rental property. Treating them all the same is the fastest way to trigger an audit or massively overpay. Let's break them down, starting with Stream 1, employment income. This is the foundation, right? You trade time for a predictable salary. It generates wealth straightforwardly, and the tax part feels super simple because your employer automatically withholds it before you even see the paycheck. But here's the dangerous trap. Assuming this workplace withholding magically covers the taxes for all your side ventures. It absolutely does not. The consequence, a massive, painful shock at tax season when you owe thousands in underpayment penalties. The hidden opportunity here is to proactively review your withholdings. By adjusting your traditional employment tax forms to account for your outside ventures, you create an automated, practical buffer against those future multi-stream liabilities. Next up is Stream 2, freelance and side hustles. Think consulting, gig work, or content creation. Now, the biggest mistake freelancers make is treating this secondary income like free, untethered spending money, instead of running it like a formal business. The consequence is brutal. You get hit with self-employment taxes that catch you completely off guard, sometimes devouring 30 to 40% of your gross earnings. But wait, there's a hidden opportunity, operational deductions. If you meticulously track your expenses, from internet bills to a dedicated home office and professional development, you can drastically lower your taxable base. The practical solution? Set up dedicated, automated accounting software the exact same day you land your first client. Moving to Stream 3, investment income. It's crazy, but there's a huge gap in how people treat their salary versus their investments. Earning money through dividends, interest, and capital gains is literally the definition of earning while you sleep. Yet folks will obsessively track their primary salary and completely ignore the paperwork for their investment growth. The consequence is triggering short-term capital gains taxes that absolutely obliterate your returns. The hidden opportunity is baked right into the tax code. Long-term capital gains are often taxed at highly favorable rates compared to ordinary income. So the practical solution is to engage in proactive tax loss harvesting and strategically hold your appreciating assets for longer than a year to lock in those preferential rates. Then we have Stream 4, rental property income. Rentals are fantastic for generating real-world cash flow and long-term equity. But man, do they exponentially increase your need for flawless organization. The most common, incredibly costly mistake here is co-mingling your property repair friends or rental income with your personal checking account. This sloppy accounting means you lose out on massive expense deductions because you just can't prove what was business versus personal during an audit. The hidden opportunity lies in depreciation and incredible operational write-offs. The fix? Open distinct, dedicated business bank accounts for every single property you own. You need an unshakable paper trail. Finally, Stream 5, online business income, like e-commerce, digital products, and affiliate marketing. These can scale incredibly fast, but online entrepreneurs are notorious for focusing entirely on top-line revenue. They love chasing those exciting daily dashboard sales numbers, but they completely neglect basic tax structuring. The consequence? They scale fast, but their accounting lags behind, leading to severe tax liabilities and late fees that can literally bankrupt a newly successful store. The hidden opportunity here is that online businesses allow for massive operational deductions, from software subscriptions to ad spend. The practical solution is implementing quarterly estimated tax payments from day one, so you never fall behind the government's aggressive schedule.
Section 3. The biggest tax mistakes when poor organization becomes expensive.
We've seen the 5 streams, but what happens when poor organization meets multiple revenue sources? The resulting chaos isn't just a minor headache, it becomes incredibly expensive. These 5 critical tax errors basically weave a mini narrative of financial destruction. First, you mix personal and business finances. This immediately strips you of legal protections and makes your accounting a total nightmare. Because your accounts are mixed, error 2 kicks in. Inconsistent income tracking. You don't know exactly what you earned or spent, which leads straight to error 3, poor record keeping. You bleed cash by missing legal deductions. Without clear records, you hit error 4, ignoring quarterly deadlines, which compounds with brutal accumulating penalties. And finally, error 5, the delusion of assuming it'll just work itself out at the end of the year. Guys, that is a guaranteed strategy for financial failure.
Let's flip the script. Section 4. The Wealth Builder Approach, Structuring Your Financial System.
Fortunately, there's a structural solution to stop those dominoes from falling. It's a systemic, deliberate approach used by highly organized wealth builders to ensure multiple income streams remain a blessing, not a burden. To achieve this, you need a 7-step master plan. Step 1. Track every single income stream independently. Step 2. Maintain incredibly organized digital records. Step 3, review your finances monthly, not just in a panic during tax season. Step 4, strictly and ruthlessly separate your personal and business activity. Step 5, save your documentation all year long using cloud storage. Step 6, thoroughly understand the exact origin and tax category of every single dollar you earn. And Step 7, create a dedicated system, often with the help of a certified pro, that just works automatically in the background of your life. The overarching priority here is number 1. You absolutely must consolidate all this chaos into one proactive tax planning system instead of reacting at the 11th hour. Imagine all these diverse streams, the real estate, the side hustle, the salary, the dividends, flowing smoothly into a single well-oiled financial machine. When you have this proactive system in place, the anxiety completely disappears. You anticipate your obligations way before a deadline hits. You optimize deductions legally, and you get the true peace of mind that comes with real, sustainable wealth building. Final section, master your financial freedom. Earning money versus managing money. Building multiple income streams is an incredible way to improve your financial security, but earning the money is honestly only half the battle. Earning is the offense. Managing it through smart, defensive tax planning is what actually keeps you in the game. And you absolutely need both to win. Remember this fundamental truth. Financial freedom isn't about how many income streams you have. It's about how well you control them. If you have 5 amazing income streams generating massive top-line revenue, but you lose 40% of your profits to poor tax planning, disorganized records, and late fees, you aren't truly financially free. Real wealth requires absolute control. So, I've got to ask, how many income streams do you currently have? Are you working with one foundational stream, or are you scaling up to manage 3 or 4? Let us know down in the comments. And hey, if you found this explainer helpful, make sure to subscribe to NexClaim for more expert deep dives on taxes, investing, insurance, banking, and total wealth building.
Take control of your financial streams, build that protective system, and we'll see you in the next explainer.